I do want to talk a little bit about the economy and more, I guess, the private sector, but I do want to get your reaction to what's going on in Washington. You had a front row seat to, I guess, how Washington operated and, more importantly, how it doesn't operate sometime. What do you make of sort of the evolution, if you will, since you've left office and what we're seeing today?
Right. Well, I don't think that Speaker McCarthy was really the problem. The problem is there are some groups within the Republican Party, especially in the House, that are very unhappy with Ukrainian spending, very unhappy with some of the welfare spending, and are very insistent that there be major changes. I think the scary part is the very fact that they're waiting till October 11th to pick a new speaker is bad, because we clearly aren't going to get any progress between the House and the Senate until there is a speaker. But then let's say there is one. It will most likely either be one of the fairly small group of very conservative people, in which case there's no reason to think that they'll be quick to compromise, or you might have a more moderate one, a Steve Scalise, someone of that sort. But it's not clear to me how Scalise or anyone like that would be able to solve the structural problem that there aren't enough votes that are willing to come to something similar to what the Senate is likely to pass.
I am
So I
curious.
think you're going to have stalemate for a while, and I think the danger of a shutdown is much higher today than it was the day before yesterday.
What do you think maybe could actually provide some degree of compromise? I mean, we know there's an underlying issue here. I mean, let's just set aside all the theatrics and politics that we know drove some of what we saw this week. There is a fundamental question here about our fiscal responsibility as a nation, our debt servicing costs, and what, if at all, we can trim in our budget going forward to address some of those issues. Is there anything that you see in there, in our budget, that could be, I guess, ample for some sort of common ground on both sides of the aisle?
Well, yeah, I think there are some things. For example, there's quite a lot of money that had been previously appropriated that hasn't been drawn down. If that would be frozen at the levels where it is, that would go some ways toward solving the problem without taking away from some of the new initiatives that they're wanting to have. There's still money left over from 2020, from the anti-pandemic moves that were made. It seems to me that trimming that, or it's just stopping it, would be a relatively easy fix, albeit it doesn't go the full way to where Representative Gates and some of the others would like this to be. But that's one area that I think would be relatively painless.
Let's talk a little bit more about the possibility of a government shutdown, because as you mentioned, of course, we're not going to get a new House Speaker immediately. And then, of course, we're coming up against that deadline in mid-November, at which point we could see the U.S. government shut down. We've had Moody's come out and warn explicitly about shutdown risk when it comes to the U.S. credit rating. How are you thinking about that? And does necessarily the U.S.'s credit rating really tie into what its creditworthiness actually is?
Well, I don't think the rating matters as much as investor attitude. No government ever really repays its debt. They all roll it over. So as long as the debt can be rolled over, it doesn't matter if you're AAA or AAA minus or AA or whatever. The real key is, will people continue to roll it? And about 1/3 of all the federal debt comes to be rolled over within the next 12 to 15 months. So that's around $11 trillion needs to be rolled over. If that gets rolled over satisfactorily, whatever the rating is, rating may influence the price of it. But personally, I don't think the rating is going to have too much to do with availability at this stage. Remember, they're not talking about making the U.S. Treasury a junk bond. They're talking about small gradations. So while it's a bad symbol, it's bad for morale, has bad longer term implications, I don't think the immediate implications are particularly severe.
Well, to your point that it's investor perception that matters and maybe a few notches on the rating system don't matter that much. When you think about the symbolism of it, do you worry at all that foreign investors might be less willing to buy our debt, of course, as the U.S. debt supply continues to go higher?
Well, the other problem is that not only will the interest rates be going up by a couple of hundred basis points on some $11 trillion next year, but also the money that the Federal Reserve had been paying over to Treasury. They pay over most of their profits to Treasury. Well, those profits are getting smaller because they're largely in fixed income, long-term bonds, and the shorter rates with which they're funding that are going up pretty rapidly. So there's going to be a lot of pressure, budgetary pressure, in any event at the federal level.